What if you woke up tomorrow, checked your phone out of habit, and realized the numbers no longer made sense? Your bank app wouldn't load, stock tickers were frozen, ATMs showed error messages, governments were silent. Markets, the invisible engine of modern life, had simply stopped. This isn't a movie plot or a fringe conspiracy whispered in internet forums. It's a question that has haunted presidents, central bankers, hedge fund managers, and military strategists for decades. What if the global economy collapsed overnight? Not slowly, not through a long recession, but all at once, like a power grid going dark. To understand how real this possibility is, we need to look at how fragile the system truly is, how it was built, who controls it, and why a single shock could unravel everything humanity has spent centuries constructing. To grasp the scale of such a collapse, we have to go back to the foundations of the modern global economy. After World War II, much of the world lay in ruins. Europe's industrial base was destroyed, currencies were unstable, and trust between nations was fragile. In 1944, representatives from 44 Allied nations met in Bretton Woods, New Hampshire, to design a new financial order that would prevent another global depression. The result was the Bretton Woods system, which pegged currencies to the US dollar and the dollar itself to gold at $35 an ounce. Institutions like the International Monetary Fund and the World Bank were created to stabilize currencies and fund reconstruction. The United States emerged as the anchor of the system, holding the majority of the world's gold reserves and controlling global liquidity. For a while, the system worked. Trade expanded, economies rebuilt, and living standards arose across much of the world. But the stability came with a hidden cost: dependence. Countries depended on the dollar, banks depended on central banks, growth depended on debt. By the late 1960s, the U.S. was spending heavily on the Vietnam War and domestic programs, printing more dollars than it had gold to back them. Foreign governments began to question whether the dollar was truly as solid as promised. In August 1971, President Richard Nixon made a decision that would quietly change the world forever. He suspended the dollar's convertibility into gold. Overnight, the global economy shifted from a gold-backed system to one based entirely on trust. Fiat money was born, backed not by metal, but by confidence in governments and institutions. From that moment on, the global economy became faster, bigger, and more complex, but also more fragile. Financial markets exploded in size. Derivatives, futures, options, and complex financial instruments multiplied. By the early 2000s, the notional value of derivatives alone reached hundreds of trillions of dollars, many times larger than the global GDP. This was not inherently evil or malicious. It was efficiency pushed to its extreme. Capital could flow anywhere, anytime. Risks could be traded, hedged, and repackaged. But complexity has a dark side. When systems become too interconnected, failure doesn't stay local, it spreads. The world got a glimpse of this fragility in September 2008. Lehman Brothers, a 158-year-old investment bank, collapsed after being unable to refinance its debt. What followed was not just a banking failure, but a global panic. Credit markets froze. Major banks stopped trusting each other overnight. Stock markets around the world plunged. Governments scrambled to bail out institutions deemed too big to fail. At the peak of the crisis, the global financial system was hours away from total collapse. ATM machines were at risk of stopping, payrolls couldn't be processed, international trade threatened to grind to a halt. The system survived, but barely, and at the cost of trillions in newly created money. That rescue created a dangerous illusion that collapse could always be prevented. Central banks cut interest rates to near zero and launched massive quantitative easing programs. Money flooded the system. Asset prices soared. Stocks, real estate, and bonds inflated to historic levels. Inequality widened, debt exploded. By the 2020s, global debt surpassed $300 trillion, more than 3 times the world's annual economic output. Governments, corporations, and households all became addicted to cheap money. The system was no longer just leveraged, it was dependent on constant intervention. Now, imagine the collapse happening overnight. It wouldn't begin with a dramatic announcement. It would start quietly, almost invisibly, perhaps a geopolitical shock, a sudden military escalation between major powers, a cyber attack on a critical financial infrastructure, or a loss of confidence in a key currency. The first sign would be in the bond market. Yields would spike as investors demanded higher compensation for risk. Central banks would try to intervene, but liquidity would evaporate faster than they could react. Banks, unsure of counterparties' solvency, would stop lending. Overnight lending rates would explode. By morning, stock markets would be in free fall. The real shock wouldn't be the falling numbers on screens, it would be the breakdown of trust. Modern economies don't run on cash, they run on promises, IOUs between banks, companies, governments, and individuals. When trust disappears, those promises mean nothing. Supply chains would fracture within days. Supermarkets operate on thin margins and just-in-time deliveries. If credit freezes, trucks stop moving, shelves empty faster than people expect. Energy markets would seize up as traders refuse to deliver without guaranteed payment. Oil, gas, and electricity prices would become meaningless as physical shortages emerge. Governments would declare emergency measures. Banks would close temporarily, just as they did during past crises, but on a much larger scale. Capital controls would be imposed to prevent money from leaving countries. Withdrawals would be limited. Digital payments might be suspended to prevent runs. The irony is that in a fully digital economy, shutting down transactions is easier than ever. What was built for efficiency becomes a switch that can turn society off. The most absurd and terrifying part is how quickly normal life would unravel. Within a week, millions of people would realize their salaries aren't coming. Pension funds would be frozen. Insurance companies would fail as asset values collapse. International trade would shrink dramatically, hitting countries dependent on imports for food and energy. Emerging markets would be devastated first, but no country would be immune. Even the strongest economies rely on global trade, global finance, and global confidence. The shock wouldn't stop at economics. Politics would fracture next. Governments would face protests, riots, and power struggles. Populist movements would surge, blaming elites, foreigners, or institutions. Democracies would be tested as emergency powers expand. Authoritarian measures would be justified in the name of stability. History shows that economic collapse often precedes political extremism. The Great Depression didn't just bring unemployment, it reshaped the world's political landscape and set the stage for global conflict. As the crisis expands, international institutions would struggle to respond. The IMF could offer emergency loans, but its resources are limited compared to the scale of a total collapse. Central bank coordination, like swap lines between the Federal Reserve, the European Central Bank, and others, might delay the worst outcomes, but only if trust still exists. If the collapse is rooted in a loss of faith in the system itself, no amount of liquidity can restore belief overnight. The climax of this scenario is not hyperinflation or deflation alone, but a monetary identity crisis. Money only works if people believe it will be accepted tomorrow. If that belief breaks, people revert to alternatives: hard assets, commodities, foreign currencies, even barter. Digital assets might surge or fail depending on trust and infrastructure. The world would fragment economically, reversing decades of globalization in months. Borders would matter again, not just politically, but economically. The most unsettling secret is that policymakers know this. Central banks run stress tests on scenarios involving market shutdowns, cyber warfare, and systemic failure. Governments plan for continuity of operations during financial collapse. These plans exist not because collapse is impossible, but because it is conceivable. The public rarely hears about them because confidence is a pillar of stability. Talking openly about collapse risks making it happen. For years, the narrative has been that the system is resilient, adaptive, and under control. Crises are framed as manageable bumps on a path of progress. But resilience has limits. Every intervention pulls future risk into the present. Every bailout increases moral hazard. The longer imbalances persist, the more violent the correction becomes. The overnight collapse is not a prophecy, it's a reminder of how tightly wound the system is. Eventually, if such a collapse occurred, the truth would emerge in fragments. Leaked documents, insider testimonies, post-crisis investigations would reveal missed warnings,